Welcome everyone to the Velocity Investment Partners 2024 U.S. Presidential Election Conference Call. We are now entering the final act of this dramatic and likely highly consequential 60th presidential election. The polls are too close to call, yet the candidates' positions could hardly be more polarized, leaving little room for nuanced analysis. Every 4 years, investors deal with pre-election pressures that tend to intensify in the months leading up to a U.S. presidential election. The concerns stem from more than just which candidate will win. There are other big questions to worry about too. How will the markets react before and after the outcome? How might policy change, and what types of companies could be affected? Uncertainties like these fuel anxiety and fear, driving volatility in the equity market. Plot twists have not been in short supply. A failed assassination attempt, Biden's withdrawal, Harris rising, celebrity endorsements, another failed assassination attempt. This election is not a typical presidential cycle. As with every presidential election, the Democrat and Republican parties' views differ in a number of policy areas. We take a look at key categories, each party's priorities, how the market moves, and how certain types of companies may benefit from if their party prevails. So John, let's dive into it. Why is this not a typical presidential cycle?
I think there's two big reasons why this year is not a typical presidential year. The first is that, historically, returns in the election year are positive, but not as good as the year before. On average, since 1952, the average election year is only up about 6%, whereas the year before was up 16%. And this year, we have had back-to-back years of double-digit returns. So that is one major difference in this presidential cycle for investors. And part of that is also related to the difference number two, in that volatility typically peaks and spikes in the months prior to the election, with September historically being the softest month. This year, even though we had some volatility in August and September, both months ended positively, and the drawdowns were very short. And overall this year, volatility has been lower than average, with April the only negative full month for markets. And I think one of the reasons for that, or Brianne and I believe that it's been a combination of interest rates. Rate cut expectations have disrupted the typical seasonality of a presidential election year. And the other driver has been the AI boom, boosting productivity and corporate earnings, and we've seen that optimism for AI and artificial intelligence, whereas expectations are for annual growth to be almost 50% higher because of the productivity increases that AI can bring. And I think what a lot of people are worried about, Brianne, are whether or not the market rally is going to be derailed, or if this momentum will continue on into 2025. So maybe you can touch on that.
Yeah, I think, we say this to a lot of clients, but to reiterate our view and our stance and outlook is that we are optimistic on the market for the last quarter of 2024 and into 2025. I think that markets historically rally a year or 12 months after an election, and also when we are seeing a rate cutting environment, which we are experiencing in both Canada and the U.S. So with rate cuts, strong profitability, and a soft landing, this really is presenting and setting up the markets for, potentially double-digit returns, as we usually see the markets up 17% when interest rates are going down, and growth is still accelerating, which is what we are experiencing. So the economy is on track for a soft landing. We're seeing about 4% unemployment, new jobs in September, and still GDP growth in Q2 for the U.S. So in the other hand, corporate earnings are expected to rise 15% in 2025. So all else being equal, we do expect the markets to be up and to be bullish and up double digits. So even after a post-election, we see an average of 16% 1-year return. So looking at even, more bearish years like 2008, when we were in a recession, we saw the markets actually up to almost 7% post-election. Another reason, again, why we are optimistic in 2025. But I do want to highlight that we do think we are going to be experiencing some short-term volatility, and a correction at this point wouldn't be out of the cards. We wouldn't be surprised if there's anywhere between a 5 to 10% correction, which would put us more closer to that 200-day moving average. I think with the recent rise up in stocks, and some negative news coming around, there has been some short-term volatility that we expect to lead up to the U.S. election, but that is normal as well before we kind of see this strong finish through November and December, and then likely to expect to continue that momentum through to 2025. So I do think we are more bullish than bearish, and that is something that we will continue to reiterate to clients. But John, I guess, one thing that I just touched on, and it would be great if you could expand a little bit, is the impact that the election will have on both the economy and corporate profits of the companies that we're invested in.
And that's ultimately key for us. When the two are very much connected, we have a strong economy, then corporate profits are typically strong, and when the economy is weak, corporate profits start to tighten up. So the policies of each candidate are going to have a critical role in shaping the economic growth. And under Harris, she's got a platform that's more focused on domestic competitiveness. And we think that that could drive some growth in renewable energy, semiconductors, and infrastructure, and potentially increasing profits for companies in those sectors. We expect the status quo, maintaining the current trade policies and stability, which will allow businesses to plan more effectively, and that could lead to steadier corporate profits as well. A weaker U.S. dollar under Harris would make U.S. exports more competitive globally. So I think that the global aspect of her platform will keep some pressure on the U.S. dollar as well. And we know that there's significant spending on infrastructure and domestic industries that could drive some inflation in the short term. And inflation would obviously squeeze profit margins. So we have to watch that as well. Under Trump, tax cuts and lower corporate tax rates would provide a boost to profits across multiple industries, especially for U.S. producers. On the other hand, he's got tariffs that come with downsides. They may offer some short-term benefits, but economists have said many times that protectionism could actually reduce productivity by about almost 1% over 5 years. So the tariffs could actually end up causing more issues than solutions on that. In the short to near term, sectors like steel, aluminum manufacturing could see gains from Trump's tariffs and the America First policies. But import-reliant industries like technology and automotive may feel the pressure on profit margins due to the higher production costs associated with the tariffs. It's this mix of positive and negative impacts that adds uncertainty to the outlook, but we think that it could be a defining feature of a possible second term for Trump. And Brianne, maybe you can touch on more sector-specific benefits that we think that other sectors will take a hit maybe, and others that will see a benefit.
Yeah, I mean, I know, John, you mentioned kind of the steel, aluminum manufacturing, America First policy, but I think from a broader sector base and scenario and how we really manage portfolios is historically trends don't clearly indicate which sectors will benefit the most from each party's victory. It really depends on where we are in the business cycle. That is more important to us. So, and that kind of helps to indicate which political outcomes could, unfold the most. So that is where we look at, we think we're still in a bullish market. We don't think we're in a recession. We don't think we're in a bear market. So I think that is important to also highlight to investors and to clients. But By analyzing, these key policies of each candidate, we can get a sense of which sectors are likely to thrive and which might face challenges under each party's leadership. So, again, discussing under Trump, we could see, and you mentioned this, John, the energy and also financial sectors, would thrive and do well, and we would see a boost from them with deregulation, tax cuts, giving traditional industries like oil, gas, banks really a solid run up. Healthcare too would see less regulatory pressure. So that would be easier for private companies to profit, which we would see, a boost from the healthcare stocks. However, Trump has said his tariff heavy approach could also hurt industries that rely on global supply chains like manufacturing and tech, despite helping domestic players like steel. So all things that we will be monitoring and watching. Under Harris, however, she does focus on renewable energy, and that is a big push, AI and infrastructure. So sectors like housing, industrial, and possibly tech would all benefit under her leadership. Defense spending would increase with, we see continued support for Ukraine. And unlike Trump's approach to ending the war at all costs, even in unbeneficial terms for Ukraine, healthcare could struggle and likely struggle under Harris, though Medicare spending rises. Pharmaceutical companies might face profit hits from drug price negotiation. So again, we will look at shifting and potentially overweight or underweight certain sectors depending on who the party's leadership is in-house. So John, do we think, a lot of how we manage portfolio too is not just on sectors, but also we look at currency and Canadian US exposure and global exposure. Will we see currency movements that help or hurt our portfolios?
Yeah, and we're actually going to hear from one of our experts in macroeconomic analysis on this here soon, but we know that currency movements will depend on the election outcome as well. Under Trump, the U.S. dollar could see it strengthen just with the tariffs that are going to be implemented, and that typically would be the big reason why the U.S. dollar would get stronger. We also expect the America First agenda would besides having a universal baseline tariff of 10% on all imports and an increase on Chinese goods to more than 60%, it'll lead to reduced imports, which decreases the outflow of U.S. dollars and reduces the U.S. dollar supply abroad. So that's one of the big reasons why we expect a stronger U.S. dollar for that reason. The stronger domestic growth expectations that we would see under Trump through tax cuts, the reduced regulations, increased production in industries like oil, gas, and gas would boost the economy. And a stronger economy generally leads to higher interest rates, which then attracts foreign capital and increases the demand for U.S. dollars. So those are some of the reasons why we think under Trump, the U.S. dollar would potentially get stronger. The uncertainty, though, of his policy, especially his global or international policies, could lead to trade wars. We have no idea what he's got in mind. We all know that he likes to kind of negotiate hard and say some pretty outlandish things. So the global economic uncertainty that could come from that would also lead to a flight to safety, and flight to safety is typically the U.S. dollars. So under Harris, because it's status quo on most of the policies that we are aware of right now, the U.S. dollar and the FX would probably hover in this similar range, maybe get a little bit softer under Harris. So that's our expectations there. We do trigger take some profits and trigger some gains when we see the U.S. dollar spike up above a certain level, usually around the 139, 140 level, which is where it's right around that level now. We'll monitor our U.S. exposure. We'll use hedges where we can, and we're implementing some changes to the portfolio right now to protect the portfolios against appreciation of the U.S. dollar as well. So, but Brianne, maybe you can touch on how else we're actively managing the portfolios to protect the profits that we've had this year and remain well positioned for various scenarios.
Yeah, as you mentioned, John, we have been taking profits and been raising some capital as well, especially with the recent rally we've seen up, particularly in stocks and sectors like utilities and materials, to lock in some of the gains that we have experienced, especially with the broadening out of the market. We are strategically increasing our cash reserve, so we're looking at anywhere between kind of that 4 to 9, potentially 10% of cash, to take advantage of opportunities during this period of volatility. And we do expect short-term volatility. So we will look at then keeping this cash, waiting for the pullback, and then look at deploying and picking up some stocks when we see the sell-off and holding those positions through to year-end and through to 2025. So I think that's, again, a way that we like to show our active management, how we have been rotating and making changes through the portfolio through volatile times. I think sector-wise, we are reducing exposure to more sensitive areas like energy and industrials, while increasing our positions in some defensive sectors like healthcare. We have also adjusted, as you mentioned, U.S. Canadian positions. So again, looking at not just sector, but geographic asset allocation to better coverage in case we do see additional USD appreciation to help mitigate our currency risk. So we do continue to maintain diversified portfolios across our sectors and asset classes to manage risk effectively, while positioning for growth for the year ahead. So we do think, we have a plan A and a plan B, depending who does get into office, and we will execute accordingly, depend on who that next president is. So John, I guess, what do you think investors can expect for portfolios over the next year?
Yeah, I think as markets adjust to the economic and geopolitical developments, including, continued rate cuts and the election uncertainty disappearing, we think there'll be some volatility, especially towards the end of the year and into the beginning of the year, into the next year. But as you said, I think to summarize would be that we're optimistic on the next 12 to 24 months. For the big reasons in that corporate earnings are projected to rise by 15% next year, so that's a strong potential for continued gains. Some of that is definitely pulled forward, I think, with the strong year we've had this year, but the markets can still go up by 8 to 10% next year with corporate earnings still growing. We've got the uncertainty of the election being over. We've got, interest rates coming down. So there's a number of positive catalysts with very few reasons to be defensive or concerned, although we always keep an eye on it. We think that defensive sectors like healthcare will provide some stability, and sensitive sectors like energy and industrials could experience more volatility. So we think that markets in general are going to follow their usual path post-election, regardless of who wins. And, as we close out 2024, the key factors prompting caution and concern right now should start to disappear. And I guess the only thing we're really concerned about that we're keeping a close eye on are high asset valuations, so the price relative to the earnings that we're getting, geopolitical contentions, and we'll always be watching for macroeconomic headwinds and whether or not the tide is starting to turn on the economy.
Okay, we also have a special guest, Lauren Gavsey, who is Senior VP, Head of Macroeconomics and FX Trading at CI Global Asset Management, a company and management teams that we work very closely with a lot of our clients and for our portfolios. And in his role, Lauren is really responsible for leading dedicated team harnessing the global expertise and knowledge across CI, global asset management, really producing insights to be leveraged for investment purposes and providing our clients with timely and valuable insights. So he brings over 25 years of experience in the industry, specializing in currency trading and global markets. And he holds an MBA from the London School of Economics and Politics. So he is a great guest that we are fortunate enough to have to answer some questions that we have from clients. So Lauren, we will get into it. Thanks so much for joining us.
Thank you very much for having me.
So we have a question. What direction do you expect the US dollar to move relative to the Canadian dollar, as well as the G7 baskets, really, if the Republicans take majority and then if the Democrats take majority?
Sure. So I think we're already seeing the market price in or anticipate a Trump win. So the polls and the betting odds are all starting to favor the potential for a Trump victory. And what that means is we're seeing US yields rise. We're seeing certain sectors within the equity market start to perform quite well. And we're starting to see the US dollar strengthen. All of those three things aligned, kind of the same trade, the same theme. So it gives us a sense of what the market is expecting or where we expect the US dollar to go in the circumstances scenario of a Trump win, and only accelerating a little more if the Republicans were to sweep both the president and the Congress. As far as how much US dollar strength, we have to think about what's driving it or what would be driving it. The first thing that comes to mind, of course, is the tariff story. So the one kind of condition I'll put around all of my thoughts is we're hearing a lot of rhetoric, a lot of jawboning through the campaign or through this kind of lead up to the election itself. What actually comes into fruition, what can actually be put into reality is still a bit of a question mark. And Trump has shown that he will make very big statements, which are primarily intended to be negotiating tools as opposed to a very specific idea of we're going to, as one example, implement a 60% tariff on all Chinese imports. So the details are going to matter, but ultimately tariffs generally mean the country that's imposing tariffs will see their currency appreciate against the country where those tariffs are being targeted. So as an example of using US and China, if we were to see a 60% type tariff, you would expect to see considerable appreciation, not necessarily to the level of 60%, but certainly 5, maybe 10% US dollar appreciation relative to China, where effectively they need their currency to depreciate to offset some of those tariff costs. So in Canada, we potentially could see a bit of currency weakness if tariffs were to be targeted against Canada. So you'd see the US dollar rise, Canadian dollar start to drop off. But, and this is a big but, it's highly expected that most countries will actually implement or announce some form of retaliatory tariff. So then you see the opposite effect playing out. So it's unclear to us exactly how much US dollar strength to expect, because over kind of the medium term, you're going to see this tit for tat type of action or behavior, which could just lead to considerably more volatility in the currencies. And like I said, initially, probably a little more US dollar strength, or foreign currency, Canadian dollar, euro, and all the other major currencies out there, most likely would start to weaken off a little bit. The second piece of that puzzle in a Trump win would also be the inflationary pressures that tariffs bring. And of course, if you start to see a pickup in prices, because effectively US consumers are going to be faced with higher prices, the cost to purchase the goods that they're used to having access to will start to rise, because it's going to be more expensive to bring that product into the US. So those inflationary pressures, in theory, will take interest rates higher. And higher interest rates tend to support a currency or give investors reason to want to own that currency relative to others. So on an interest rate differential basis. So we do think most likely outcome is US dollar strength on a Trump win. However, again, something else Trump has been commenting on is his preference for a weaker dollar. So how he can actually achieve that when you're creating tariffs, creating this kind of upward pressure on the currency, and then talking out of the other side of your mouth saying, I want a weaker currency, there's very few steps that he can take to actually affect the currency and push it lower. All of them are what I'll say undigestible from a foreign investment standpoint and quite concerning. So I don't expect him to have a whole lot of success in weakening the currency, but there are steps like capital controls or pushing for lower interest rates, which means having some effect on the independence of the U.S. Federal Reserve. If that comes into doubt, then it throws into question the comfort that one should have going into U.S. Treasuries, as an example. That could undermine the value of the U.S. dollar. But again, that's just not my base case. I don't think he'll go that far because of the potential long-term consequences. On the Harris side, if we see a Harris win, to me, it's a bit more of the status quo from a policy standpoint. And I think we can continue to see the U.S. dollar actually weaken very slowly, more so because of the macro backdrop and less so because of a newfound or a shift in policy from Harris.
And with that in mind, I guess the tariffs can come from both sides. Dems have we had the software issue between Canada and the U.S. before under the Democratic Party, so there's no it's not just a Republican issue. But with that in mind, what sectors do you think will either get hit both get hit the hardest, and others that'll benefit the most under each party's majority based on those policies?
So I think the bottom line is we're going to see a fiscal impulse regardless of who goes into office. The question is just how big of a fiscal impulse. So from the Harris side, we'll likely see higher taxes potentially. But the point being, we'll continue to see support for the economy. If you think about the Biden administration, they've been very supportive through the Inflation Reduction Act, the IRA, as well as the CHIPS Act. So they've really been generating a lot of growth, a lot of productivity, and a lot of investment into the U.S. tech sector as one example. The consumers remain quite resilient. I don't think any of that really changes in a Harris win. The question more so becomes, what's different under Trump? And we already know from his first term, there's a big focus on deregulation. So when you think about which sectors tend to benefit from lower, less restrictive regulation, the big ones are energy, utilities, and the financial sector. So we really think that's where we could see a little bit of divergence in the sense of a new or Republican government coming in. Those sectors are where we're mostly focused on potential opportunity and upside.
Mm-hmm. And when we saw, the Republicans win in 2016, they, as you mentioned earlier, we saw them cut corporate and personal taxes and kind of giving a boost to the markets and earnings. What are some of the scheduled tax changes in 2025, 2026 to kind of watch out for?
Well, it's a really important question, and it kind of goes back to what I mentioned about the fiscal impulse and the risk of a growing U.S. debt profile or growing annual budget deficits. So if you think about, okay, where's the revenue coming from? You think about the Tax Cut and Jobs Act that was implemented by Trump back in 2017. They lowered the corporate tax rate from 35% to 21%. That is due to expire in 2025. And the expectation is a Trump win would see him not only extend that program, but potentially actually lower corporate tax rates down to the high teens. I've heard numbers in the neighborhood of 18%. Whereas we're hearing from the Harris camp that they would likely, first of all, they wouldn't necessarily extend the full Tax Cut and Jobs Act. They would be more focused on raising taxes, call it for the higher income earners, and lowering taxes, making life easier for the lower income earners, and all the while taking corporate tax levels higher. So one way or the other, we're going to see a rising deficit. The question is just which one comes in. Trump is going to be even worse for the deficit, at least that's what the projections look like, whereas Harris would be a little more balanced and maybe less concerning for that deficit side. Either way, both are expected or projected to take that deficit considerably higher than where the current glide path is for U.S. debt.
Okay, and speaking of the policies and pardon me, the domestic policies under each candidate will obviously influence, global trade, the protectionism that Trump wants, the open markets and globalization that Harris wants. So, do you think that Canada could potentially benefit from that with new partnerships globally if the U.S. is going to become a little bit more America first, or is Europe gonna be able to benefit if with new trading partners, or is the U.S. such a large customer globally that it will have a negative impact on global economics?
Well, I think we really have to look at the first term for some hints as to how things may play out. Trump obviously took a very USA first approach, and that's certainly what he's campaigning on again. But what you also saw was it forced other countries to sharpen their pencil a little bit and become a little more aggressive. So what does that mean for a country like Canada? Well, firstly, yes, there's potential for trade tariffs. Of course, we have the free trade agreement in place. It is potentially up for review in a couple of years. But the bottom line is a U.S. protectionist type story still requires natural resources, still requires a lot of the things that Canada produces. So to me, there's not as much downside, whereas for other countries, you could debate. We could point at Mexico as one example. Not only they a big producer into the U.S., but they're a low-cost producer, arguably anti-competitive when Trump wants to talk about building up that manufacturing sector domestically. So I don't think that Canada is necessarily going to be hurt as hard as what we may see targeted against other countries. But there's no question about it. If you take a step back and kind of say, well, does the election matter, yes or no? It's very interesting, and it could matter materially. But at the end of the day, the Canadian economy continues to be, glued at the hip, so to speak, to the U.S. economy. And right. I kind of take a step back and think, okay, yes, there's a lot going on with this election. There's a lot of potential for change. And of course, we're caught up in this ongoing news cycle and mini news cycles as one candidate starts to get a little more vocal about things or the other does. But ultimately, we've done a lot of analysis on which asset classes tend to perform best under a Republican or under a Democratic, either president or full control of both the executive branch and the congressional branch. And right. Interestingly, there's not a lot of difference. What matters most is the macro environment. How is the economy doing? And by the way, even though it's the hot point, it's the number one topic that's apparently driving U.S. voters, the economy, the health of the U.S. economy, it's robust right now. It's trucking along at neighborhood of 3.3% per quarter. Their long-term run rate is closer to 1.8 to 2%. So the U.S. economy is doing extremely well. That's important for the backdrop. Inflation's come back down under control, which means interest rates can come back down to more normal levels. That's very good for equity markets. That's very good for investors. So the outlook is promising. Of course, these policies, the potential policies could cause significant changes, whether it be at the sector level or through trade relations, could be disruptive. But ultimately, what we're focusing in on more so is the facts. The facts as we know them, the macro situation is quite good. And that's supportive for the Canadian economy over the medium to long term as well. Obviously, we're at a slower pace right now for kind of idiosyncratic reasons relative to the U.S. So I'm less worried about the election outcome insofar as how do markets continue to perform. The backdrop remains quite healthy and strong.
Great.
That's in line with what we think.
Yes, thank you so much, Lauren. And we appreciate you taking the time to answer those questions. And, again, I think we expect some volatility, as you mentioned, with the presidential elections, but that's okay. And, as we mentioned earlier on this conference call, we do tend to see volatility pick up closer to the U.S. election. But investors and our clients, can sometimes become a little bit nervous, but having our active management in place and knowing that we are making those tactical changes as well to position the portfolio for 2025. And once the election is over and the winner is named, the U.S. equity markets historically have readjusted, smoothed out, and move resiliently forward, no matter which party ends up being successful. So thank you again, Lauren, for joining us. We appreciate your time and your insights.
Thank you very much. And grab a bowl of popcorn and enjoy the show next week.
Thank you, everyone, for listening.
All right, thank you.